Good morning, traders and investors. My name is Roger Scott, and I'm the senior strategist for Wealth Press. Today is what? Today is Tuesday. It's December 14th. It's 7:17 in the morning. The market's going to open up in about 2 hours and 13 minutes to be exact. As you can see here, we have a lot of volatility. The Dow is up 9 points. The Nasdaq is down 84. It was down about 100 points. Markets are just all over the place, literally. They don't know what to do with themselves ahead of the Fed data, and there's a lot of data on the table. Let me take you through the biggest pain points, the biggest risk factors, the biggest upside, downside, try to make some heads and tails out of this market. Mostly, I think this is volatility. I don't think the market is as bearish as the tech sector and as the blue chips are making it out to be. I think this is more of a volatility issue that's causing investors to panic. If you look at the volatility index, which is the VIX, and I'll take a real good look at it, and investors have been kind of panicky last few days, you'll notice that the volatility levels are coming down. Even the gyrations we're seeing right now, they're just little blips. And remember, volatility can go higher even if the market goes higher as long as it's volatile, which is kind of what we're seeing right here. We're not really seeing this because of a major fear. Ultimately, if you've noticed historically, we tend to go up a lot and then we come down. We don't have too many of these double spikes. And even when we do, the second one is usually quite a bit lower. So in my opinion, the downside that we've seen in the market in the last couple of weeks was the downside in the market. And right now, the market is just trying to find its footing, going through major sector rebalancing because of the Fed data that's coming out and so forth and so forth. And I'll get into that. But I'm not too concerned here. Put the call ratio is moving into neutral zone from being bearish, which means the market is set to go up, not down. When markets are here, right here, this is when the markets are too bullish right here and they're set to go down. This is when markets are too bearish and they're set to go up. So the higher we go up here, the more bullish the market becomes longer term. So on the pullback down, the market becomes bullish. This is bullish and this is bearish. Again, this is bullish, this is bearish. So if we were right here, I would be very nervous right now. But we're all the way oversold and this market looks like it's going to pull back. And these two tops right here, to me, they look like a double bottom on the Russell right here. I just want to kind of show you what I'm seeing right now. Right here. Notice the top is higher, lower. This was the first fear. This was the second fear. But I think the market is ready to pull back up right now and go towards the 200-day moving average. As far as momentum levels, they look fairly stable. In terms of the bond market, although the Nasdaq is looks like it's going to open up 90 points down, the bond market is down. And with the Fed taking action later this week, possibly next week, giving us their FOMC agenda. Here, let me go back here. This whole thing, it's very hard for the market to stay up because we already know that the Fed is going to start pulling the legs under the gas pedal that are driving the bond purchases, which means bonds go down if there's less bonds being bought. So I think the bond market is trying to do everything to shake out the weak hands and the unconfident guys. But this looks like a top and two shoulders to me, and it looks like the bond market's going to cool off, which is the position that we're taking right now, and we are short the bond market. In terms of global economy, let me kind of go over global economy with you, and then we'll go on to the nitty-gritty, because there's something I need to show you, something important. U.S. is waiting fresh inflation data and the outcome of the federal meeting of the Federal Reserve. Labor Department will give us the PPI numbers. That's the 8:30 meeting right here. And as I read through it, let's just kind of go through it and I'll give you the numbers. That's coming out at 8:30, and that's going to set the tone for the rest of the session. The data shows how inflation is impacting the cost of businesses, and it's important giving the Fed meeting on Tuesday and Wednesday. The CPI came in line. Now, just to give you an idea, month over month, we're looking for about 0.5. Year over year, we're looking at 9.2. Again, these are 0.5, 9.2. If we go way below 8.4, that may be an issue. If we go way too above 0.6, that may be an issue. So keep your eye on this number. It's coming out in an hour and 9 minutes. Besides that, we've got retail sales tomorrow. That's a huge, 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 huge number. I'm expecting it to be a little cooler, but not too bad. And then we've got the FOMC announcement. So the Fed has plenty of data with the PPI, with the retail sales, with the import and export, business inventories to figure out exactly what they're going to do. I think they're going to start taking some action more over than not. Now let's go back to what we've been talking about. Global economy shares in Jimao Group, Shanghai's Jimao Group sank 20% in Hong Kong on concerns about its financial situation. That's kind of priced into the market. China's Evergrande, the Chinese company that sounds very Latin to me, Evergrande Group shares gave up 7%. Evergrande is one of the largest developers with $300 billion in debt. Chinese leaders have prompted tax cuts, support for entrepreneurs to shore up slumping economic growth as the country grapples with bankruptcies and default amongst real estate developers. It's not good. The Russell 2000 gave up some strength yesterday on weakness on concerns about the economy, but I think that's going to stabilize based on the current put-to-call ratio, which I will show you right now if I could find it. Let's, sorry about that. Which I have shown you earlier already. That's telling us that the market, is ready to go higher, not lower. Right here. So this is a sign that the market bottomed out, and that's a sign of a bottom out. So I think the market will go higher today. And the bond market being lower already and the volatility is cooling off, it looks that way. Now, I want to show you something else that's interesting. A few weeks ago, and I want you to pay attention to what I'm about to tell you. Do you guys remember a few weeks ago I told you that I see investors rotating their money out of speculative tech and consumer discretionary and into higher paying dividend consumer staple stocks, speculative to safety? I explained this to you. I've been talking about it for about a month. Well, I want to show you something. I've been talking about it so much. This is consumer discretionary. We're at the 50-day moving average. We peaked out right when I was talking about it, actually, right around the 22nd, almost a month ago, 3 weeks ago. And we've been going down. Remember I told you I expect chips to cool off? Let me show you chips and consumer discretionary market cap to go into consumer staples, which is why we've had so much consumer staples, hotel stocks, basic blue chip stocks. Well, let me show you consumer staples over the same time period that I've been telling you that it's moving higher. Look at that. Hey, all I could say is I've been saying this almost every day on this broadcast. It's like that. So, folks, today is Tuesday. And Tuesday, what do? I give you the best sector, and I give you the weakest sector, and then I give you the best stock and the weakest stock. So, looking at my stock fetcher code, the problem is it's lagging behind. And if you look still here, it'll tell you technology and communication services are, but I think we're getting close to being pulled down, especially when you look at the latest data. It's not all that great. So I would prefer to use the 3-month right now. And as you could see, energy is leading. Now, energy tends to do really well during inflationary periods. And if we look at XLF, let's take a quick look at, If you look at XLE, it's been kind of going choppy, but I think it's going to continue moving higher, and it hasn't lost all that much market cap. It's been kind of a choppy market, hasn't been very eventful, but I think energy is going to start moving up, and the worst sectors, it's still the communication service sector. I don't really understand why it's doing so bad, but it's not doing great. So the best energy stock, and I'll show you this, the best energy stock is, let's see here, Devon Energy, right there, Devon Energy. And by the way, I like Dollar Tree quite a bit as well, but that's not energy. That's more consumer staple, small store, blah, whatnot. But Devon Energy, DVN, this stock right here. And I've mentioned this several times, and it's been doing really, really well. It's been kind of choppy, like the rest of the energy sector, but this is the strongest energy stock right now. And as far as communications sector, and I said this to you when we were down here, up here, and now we're going back down. Fidelity National Information Services. This is a dog. I mean, this is a dog. And I think it's going to continue moving lower. And on this note, let's see if there's others. Let's see here. Fidelity National, AT&T Communications right there, Charter Communications right there. So you've got to pick. But communication sector is no good right now, and energy and consumer staples is where I would, or utilities, because if you look over a monthly basis, look at the sectors that are, and folks, I hate to say I told you so, but if you've been watching these videos, then none of this is new to you. I told you that consumer staples are going to start leading and defensive stocks are going to start leading, and they've been leading. They have been leading, and consumer discretionary is all the way down here. And if you don't believe me, all you've got to do is look at this chart. Kind of speaks for itself. Parabolic, which is why I've been in insurance stocks. Let's see here: insurance stocks, bank stock, financial stocks, high dividend stocks. I've got Nvidia and Microsoft, but those are leaders. Other than that, we don't really have a lot of tech in our portfolios right now, in the discretionary portfolios. So again, I think this will cool off. I think discretionary will start coming back up if the Fed data is solid. You need to pay attention to the bond market right now. I think we're going to start breaking lower, and if we hit 148, I think we'll hit the 145, 144 level, because I just don't see any reason for bonds to move higher right now. In terms of the SPY, let me give you some levels on the SPY. It looks like we're cooling off, but it looks like we're going to stay in these levels. And quite honestly, I don't really mind where we're at. I think this will fill in and we're going to go higher today. I don't think we're going to go lower. And I think we're going to continue filling this area right here. So I think the market is going to set to open a little higher. It's going to open lower and then head higher. I don't think we're going to see another day of weakness, especially in light of the fact that we've got a lot of Fed data on the table. Number one stock in the number one sector, energy. Devon Energy, communication services, the worst sector, FIS, worst stock. Now, I've got some stuff for you. I'm not ready to let you go just yet. Have you ever wondered why Wall Street always seems to be one step ahead of the average trader? Well, in 2021, one straightforward trading routine offered Lance Ippolito's readers 87 winning trades, and 50 of those trades came overnight. Overnight, folks. Now, his strategy involves quick trade at the end of the day, and more than 50 times this year, they've closed them out the very next morning. No day trading. The trade gets a full overnight, so you don't have to worry about day trading margins or anything like that. He calls them overnighters. Makes sense to me. And in the past couple of months, get this, he's pegged returns 76%, 100%, 109%, 254%. How about 925% return overnight? I'm getting numb just thinking about this. I'm getting chills on my back. This is really good. Can you imagine going to bed, waking up in the morning with a 925% return overnight? That's mind-boggling. And Lance is going live today, Tuesday, December 14th, to share the details of this strategy. Click on the link below and reserve your seat. I believe it's happening at 1 p.m. Eastern Time. If you follow the link below, it'll give you more details. And as always, make sure to like this video, subscribe to this channel. If you're watching on YouTube, especially, stay ahead of this market. Be the first to be notified when I post my next video. Tomorrow, I've got a treat for you. I'm going to give you one long and one short actionable trade idea, and I'll even give you options if you send me some nice feedback telling me if I'm helping you out with these videos in the morning, because I don't want to do them for my health. I want to do them for your benefit. Support marketgeeks.com. I want to hear from you. All right, guys? And who warned you? Who warned you that consumer discretionary was going to go down and that consumer staples was going to go up because dividend stocks are going to go higher? Who warned you about this all the way back here? Bye, guys. Have a great day. Send me some feedback. I want to hear from you. If you want me to review something, let me know. Bye.